What if you could build an investment that quietly paid you every single month, whether you worked or not? No trading screens, no panic selling, no market timing, just a steady deposit that shows up like clockwork. Rain, shine, bull, or bear. Imagine checking your bank account on the first of the month and seeing a fresh $3,000 sitting there. Not from a lottery win, not from some next big thing crypto bet, but from companies you already know, sending you a piece of their profits while you're off living your life. That's the dream so many investors chase and the trap so many fall into. Because most people hear the words passive income and imagine it's magic. It's not. It's math, patience, and discipline, wrapped inside one idea: owning things that pay you to own them. Today, we're talking about one of the simplest, most reliable ways to do that through a fund called SCHD, the Schwab U.S. Dividend Equity ETF. But this story isn't about a ticker symbol. It's about freedom. And it begins with someone who did everything right and still couldn't sleep. Meet James, 47 years old, married, mortgage-free, a model citizen of the Save for Retirement Club. He's been maxing his 401k for years, keeps a healthy emergency fund, and has zero debt. From the outside, James looks like the poster child for financial security, but every night around 3 a.m., he wakes up staring at the ceiling, doing mental math that never quite adds up because James just realized something terrifying. Despite decades of saving, he's still not sure if his money will outlive him. His advisor told him he'd need about 80% of his current income to retire comfortably, around $6,000 a month. Social Security might cover half of that if he waits long enough. That leaves a $3,000 gap every month forever. Now, most people try to fill that hole with what they've been told is safe: bonds, CDs, maybe a few dividend stocks they found on Reddit. But here's the problem. Most of those safe options don't keep up with inflation. A bond that pays 4% today might look good until groceries go up 10% next year. And the moment you need that cash, you have to sell something, often when the market's down. James doesn't want that. He wants income that feels as reliable as a paycheck but grows faster than the cost of living. Something he can build once, maintain easily, and trust through his 70s, 80s, and beyond. That's what led him to SCHD, not as a magic formula, but as a system. A machine built from some of America's most profitable companies, quietly compounding in the background. It doesn't scream, it doesn't swing for the fences, it just pays you. But before we unpack how that works, we need to face the uncomfortable truth about the typical retirement plan. Because if you think I'll just sell a few shares each month, you might already be building your future on quicksand. Let's step back for a moment. Most retirement models, the kind used by financial advisors, assume you'll gradually sell your investments over time. They even have a name for it: the 4% rule. You withdraw 4% a year, adjusted for inflation, and hope you don't run out. But that plan depends on luck. It works only if the market behaves politely in your first few years of retirement. If it crashes early, your portfolio shrinks while you're still withdrawing, and you risk running out of money decades too soon. That's what keeps people like James awake at night. Not the market, the math. He's not greedy, he just wants peace. He wants a way to convert savings into cash flow without draining the tank. That's where dividend growth investing comes in, and why SCHD is so interesting. Because unlike selling shares, dividends pay you while you keep the asset. It's like owning an orchard that keeps producing fruit year after year, even as the trees grow taller. The beauty isn't just in the payout, it's in the growth of that payout. SCHD isn't built on random high-yield stocks that promise the world and cut dividends the next quarter. It's built on companies with decades of stability, proven profits, and a track record of rewarding shareholders through thick and thin. In a world obsessed with chasing the next Tesla or timing the next crash, SCHD plays a different game. It doesn't try to be exciting, it tries to be enduring. Think of it as a river, slow, steady, deep, instead of a wave that crashes and disappears. In the next section, we'll open up that riverbed. We'll see what makes SCHD flow, what companies power it, how it grows dividends faster than inflation, and how even a modest starting sum can snowball into a life-changing stream of income. Because if James's story feels uncomfortably familiar, this next part might just be the antidote you've been looking for. Part 2, the engine behind the income. When most people hear Dividend ETF, they picture a basket of random stocks tossing out loose change. SCHD isn't that. It's a curated club, one where only companies with real cash flow and a long history of paying shareholders get in. To join, a company needs at least 10 years of uninterrupted dividend payments, strong fundamentals, and a solid return on equity. Translation, these aren't flaky startups. They're companies that survive recessions, pandemics, and boardroom drama, and still send you a check every quarter. Inside SCHD, you'll find names you probably see every day: Coca-Cola, Pepsi, Texas Instruments, Cisco, Chevron, Pfizer. They make the drinks, chips, microchips, routers, and medicines that quietly power modern life. And while tech stocks were doing backflips for attention, these firms were doing something less flashy but far more powerful, raising their dividends year after year. Each company is like a gear in the income machine. Coca-Cola might raise its dividend by 5%, Texas Instruments bumps it 10%. Over time, those increases compound and the machine starts to hum louder. That's the secret most investors miss. It's not the 3.5% yield that matters, it's the growth of that yield. SCHD's dividends have been rising roughly 10–12% a year. Do that long enough, and your income doubles every 7 years without adding a single new dollar. James doesn't need $1 million overnight. He needs a plan that lets compounding do the heavy lifting. In Part 3, we'll see how the SCHD Snowball turns patience into freedom, and why your first few years of investing matter far than your last. James didn't believe it at first. He thought you needed to trade, to outsmart the market, to stay glued to CNBC with a second cup of coffee and a twitchy finger on the sell button. But the truth about dividend investing is quieter than that. It's not about doing more. It's about letting time do the work for you. Imagine this. James invests $10,000 into SHD at a yield of 3.5%. That gives him about $350 in dividends the first year. That's barely a long weekend getaway. Not retirement money. But the story doesn't end there. Those dividends don't just sit idle. He sets up a dividend reinvestment plan. Each payout automatically buys more shares, and each of those new shares earns its own dividends next quarter. It's like planting trees that keep planting more trees. After 10 years, that original $10,000 might be paying $950 a year. Not because the fund's yield changed, but because his share count grew, and each share started paying more. That's the snowball. Slow at first, almost invisible, then unstoppable. Over 20 years, that same small investment could be paying almost $3,000 a year. That's $250 a month from something he built decades ago and never touched again. All he did was stay consistent and not panic. This is the quiet math of compounding. 3 things work together: reinvested dividends, dividend growth, and time. Miss one, and the engine slows. Combine all 3, and the returns start bending upward like gravity flipped. This is why dividend growth investors often sleep better than traders. They don't need the market to rise every day. They just need companies to keep doing what they've done for decades. Make money, pay shareholders, repeat. It's not glamorous. There's no dopamine rush. But one day you look up and realize the money showing up in your account doesn't need your permission anymore. It just arrives. That's why people call SHD a retirement fund you can live on. It doesn't require prediction, it requires patience. Still, patience doesn't mean blind faith. Let's compare it to something familiar, the S&P 500, because understanding how SHD stacks up against the classic benchmark can show you which role each should play in your future. The S&P 500 is like the all-star team. It has growth, flash, and big names. When the economy is booming, it runs ahead, but it only pays out about 1.5% in dividends. That means for every $100,000, you get $1,500 a year. That's nice, but not enough to live on. SHD, on the other hand, gives around 3.5% more than double. For someone like James, that's the difference between worrying about bills and knowing the bills are covered. The trade-off? SCHD grows slower in hot bull markets because it owns fewer tech giants that rarely pay dividends. But when the market stumbles, SCHD falls less. Its companies are boring in the best possible way. People don't stop buying toothpaste, medicine, or routers during recessions. Lower volatility, higher income, and a long history of dividend growth. That's what makes SCHD feel less like gambling and more like gardening. You plant it once, water it occasionally, and trust the seasons. That's why many investors mix the two: SCHD for income, SPY for growth. One keeps the lights on, the other keeps the fire alive. For James, that balance became a revelation. He realized retirement wasn't about a giant number on a statement. It was about cash flow he could count on without selling anything. He didn't want to withdraw his future. He wanted to live off it, so he built his plan: half SCHD for stable income, half spread between growth ETFs, bonds, and a little cash buffer. He called it his sleep portfolio. Every quarter, dividends rolled in. He stopped checking stock tickers every morning. He started checking flight deals instead. And somewhere between one dividend payment and the next, he stopped feeling like he was working for money and started feeling like money was working for him. That's what true financial independence feels like. Not fancy, just free. But freedom is built one small, consistent step at a time. So let's break it down. How much does it actually take to reach that $3,000 monthly goal? And how can you get there, even if you're starting late or starting small? Let's run the numbers. If you invest $1 million in SHD at a yield of 3.5%, you're right around that mark, about $3,000 a month. That's the simple math, but most people don't have $1 million sitting around, and that's where the time element changes everything. If you have 20 years, you don't need $1 million. You might only need $100,000 invested today. Why? Because of dividend growth and reinvestment. Over 2 decades, that $100,000 could turn into over $800,000 in value, and the dividends could grow to more than $3,000 a month. That's the quiet miracle of compounding. It's not what you start with, it's what you give time to multiply. Even smaller contributions add up. $1,000 a month invested in SHD, reinvested faithfully, could reach over $600,000 after 20 years. At that point, the dividends alone could pay $2,400 every month. After 30 years, closer to $9,000, and that's without ever winning the lottery, without gambling on speculative stocks, without panic selling during a crash, just slow, boring, repeatable math. The funny thing, most people will never experience this. Not because it doesn't work, but because it's too simple to feel exciting. They'll chase shortcuts and spend decades restarting. Meanwhile, the quiet investors will keep collecting dividends that grow, whether anyone's watching or not. James became one of them. He calls it his anti-anxiety plan. Each quarter when those dividends land, they remind him he owns a slice of real businesses, ones that never stop working. And the best part, he doesn't have to. If there's a moral here, it's this. You don't need to predict the future to prepare for it. You just need a plan that doesn't rely on luck. SCHD isn't a magic ticket, it's a method. A disciplined way to turn work money into forever money. It's what happens when you stop chasing and start compounding. If you're in your 20s, time is your greatest leverage. If you're in your 40s, consistency is your advantage. If you're retired, patience is your shield. No matter where you start, the formula doesn't change. Save, invest, reinvest. Repeat. Let the snowball roll. Because at some point, the question stops being how do I get rich and becomes how do I make my time mine again? That's what James learned. That's what thousands of SCHD investors are quietly discovering. And that's what you can start building today, one dividend at a time. If there's one thing to take away from all this, it's that wealth doesn't have to be loud. It doesn't have to flash or brag. Real wealth is quiet, reliable, and growing while you sleep. That's what SCHD represents, a way to build freedom slowly, deliberately, and without fear of running out. So wherever you are right now, saving your first $100 or managing your first $100,000, remember that consistency beats intensity. Stay the course, keep reinvesting, and let time do the heavy lifting. Your future self will thank you. If this video helped you see investing in a new light, tap that like button. It tells the algorithm and me that you found value here. Subscribe to The Passive Path for more stories, strategies, and step-by-step guides to building real financial independence. Drop a comment below and tell me your target monthly income or how you're using dividend investing in your own plan. I'd love to hear your story. And if you know someone who's been stressed about retirement or unsure where to start, share this video with them. You might change their future more than you think. Thank you for spending your time here today. I wish you clarity, patience, and the quiet confidence that comes from knowing your money is finally working for you. Feel free to explore other videos on the channel. Each one builds on the same idea, freedom through understanding. I'll see you in the next video.